Hey, good morning. This is Mayor Valensky with Driving Markets, driving while talking about markets. Hope you're all well. Like to send my heartfelt sympathy and speedy recovery to all those people in Turkey and in Syria who suffered the most horrendous effects of the earthquake, where the buildings just collapsed like a house of cards, and there were horrible sights and horrible videos you've seen. It's terrible suffering, very bad. Okay, so let's move on to financial markets. Okay, so the markets again were down, following on from the fear of rising rates. Why is there fear of rising rates when last week Jerome Powell and the Fed and everyone else was talking about rates tapering off? The mood on the street and the mood overall in financial markets was, as of last Tuesday, Wednesday, and as of the beginning of the month, that interest rates have more or less maxed out, more or less peaked, have more or less come to the end of their run. However, the non-farm payrolls, which is a massive number economically, on Friday sent all of those theories into the trash can. Okay, that number was so big, 517,000 jobs were created in January. It's so big, it's brought back onto the table, back onto the boardroom, the discussion of rising rates. Rates have not stopped rising. Rates will continue rising all the way through to June, July. The Fed is not going to stop raising rates. We need to get that clear and need to get it out there. It's a clear message. And the reason being is because you've got two main factors at the moment that will be driving rates higher. Number one, undercurrent of full employment, undercurrent of wage inflation. So wage inflation is in the States is solid at 4.4%, but with more and more demand for labor, that wage inflation is going to take off. Okay, that's going to frighten the Fed, and that's going to force them to take further interest rate action. The other one is the CPI. Now the CPI has tapered off, official number CPI has tapered off over the last 2 or 3 months, indicating to the street and to traders that inflation has peaked. Now remember, that's the official headline inflation number. The cost of living of what you feel is inflation is much higher in your pocket than it is what the official number is stating. So the official number is stating 6.5%, but we know that inflation and actual cost of living is much higher if you include everything in that you're buying on a daily basis. So that's CPI. That retail price inflation is also going to rise. I think, in my opinion, there's been a lull over the last 2 or 3 months in CPI, but I do believe now that we're going to go back on the uptrend. So you're going to have a retail price index inflation rising and a wage inflation rising, and what you're going to have is the Fed going into panic mode. It's going to have to increase interest rates significantly because it's not either having the impact it wants to have, and also it can see that the economy is resilient to interest rate rises. Remember, with 517,000 jobs being created, that shows a pretty strong economy. With a pretty strong economy and interest rates in the States at 4.5 to 4.75% Fed fund rates, then you are talking about a resilient economy. And as long as it's resilient, then the Fed will be empowered to raise rates even further. Okay, so it's very important to take that into account. Look at the 10-year Treasury. The 10-year Treasury, US Treasury, which is the benchmark lead indicator of where yields and interest rates are going, is running at 3.63%. We're all the way down to the low recently of 3.35, indicating that rates have tapered off and they're going to drop. Now it's shot up there. Now the 10-year Treasury is likely to go up to 4.5% by June 2023. And that is a measure to see what is the market, what's the bond market showing regarding interest rates. And the bond market is indicating higher and higher interest rates. Remember, the bond market is the real market in Wall Street. The equity market is essentially the secondary market, but the real market, the real traders are bond traders. Something to look at. Look at foreign exchange. The dollar's strong. Why is the dollar strong? Because there's expectations that rates will rise further. So the dollar's strong against the pound, the euro, and the yen, and will get stronger. The question is, will the DXY index move up another couple of points and put it back into serious bullish territory? I believe it will. So I'm a big bull on the dollar. Gold has gone down, even though it went up yesterday slightly, and oil has come down, even though oil went up slightly yesterday. So the commodity sector is being under pressure. Gold is at 1883. It's came all the way down from 1947, and likely to go up to $2,000. That's my immediate call on gold, to $2,000. Oil, I'm calling up to $85 to $90 in the very, very near future. I think there'll be a massive demand on it in China, and there'll be a shortage of oil that'll just push the price even further. As far as Bitcoin's concerned and cryptos, you're going to have them seriously under pressure as rates rise. And as rates rise, what's likely to happen, you'll see Bitcoin come off. Bitcoin struggling at the 23,500 level, 24,000 level. It doesn't seem to get there, and therefore it's likely to come all the way, if interest rates rise, likely to come all the way down to the 19,000 level, and then from there it's a big test of where it's going to go. I'm not too sure. I've always been calling it much lower. If legislation comes out in the US that restricts cryptocurrencies, you'll see Bitcoin all the way down to about $500 a coin, and that will take all these people who've got FOMO will probably pile in. As one guy wrote, he goes, he'll be all in, he'll be Texas all in. He'll buy everything on Bitcoin because people do believe that Bitcoin is going to go to $250,000 a coin. I personally don't feel like that could be. I think there's going to be a lot of legislation, a lot of factors this year are going to hold it back. And as long as interest rates remain high, then Bitcoin is going to be under massive pressure going forward. Okay, Amazon, CRM, Salesforce, Intel all fell yesterday. Tesla was up. Wedbush came out with a buy recommendation for Tesla. So Tesla is running around the 180 level. I think Tesla is going to come off to around about the 140 level in the near future before climbing up again. And that's more or less it from Driving Markets. You can subscribe on TikTok and Instagram. You can share. You can pass it on to your friends. I want to get the viewings up. Let's make it exciting. Hopefully getting good content from this channel. Have a good day.